So the National Association of Realtors just released a new real estate market report, which I think is going to have pretty big implications, not just on the real estate market, but our economy as a whole and possibly even your 401k. So the report we're going over today is the Commercial Real Estate Trends and Outlook Report, which goes over the numbers for Q3 of 2020 and compares those numbers to Q2 as well as Q3 2019. The one number that really stood out to me in this report is the hotel, hospitality, and retail malls have declined in value by 7% compared to this time last year. So $1 million commercial property has just lost $70,000 in value over the last 12 months. And it's a pretty big contrast compared to the residential space, which has actually seen an increase in value by 16% compared to this time last year. And this does make sense with the hotels, since a lot of people are simply not traveling nearly as much as they did last year. And the same thing with malls. Personally, I haven't been to a mall pretty much all of 2020. And what's interesting is that I think that the hotel hospitality space, that is going to recover probably next year. Once this whole situation is over, I predict a lot of people are going to start traveling a lot more. But the retail stores and malls, they may not recover nearly as quickly. I think a lot of people have simply gotten into the habit of just ordering everything on Amazon over the last few months, and breaking people of that habit next year is going to be a real challenge for the malls and retail stores. And malls have already been suffering dramatically over the last 10, 20 years. We're seeing malls shutting down all across the country, and I have a feeling that we're going to see a lot more malls shut down in 2020 and even 2021. And the report goes on to say that office spaces have also declined in value by about 4% this year. Senior housing has declined in value by 2%. Land, surprisingly, has not declined in value at all. And actually, industrial spaces and warehouses have actually increased in value slightly in 2020. And we also see in the report that leasing volume in retail malls was down by 9%. Most likely, this is the reason why the mall's value have dropped. They simply can't get enough store owners to rent their spaces, and they're probably going to start seeing a lot more vacant stores within the malls. And I think this number in a lot of ways is quantifying how small and large businesses are being hurt in 2020. This indicates that within the malls, a lot of these smaller stores have had to close their doors permanently, and a lot of the bigger stores are closing down specific branches of their stores or simply not expanding like they once did. And the report also shows that the actual lease terms that these store owners are signing with the mall is much shorter than they once were, and that's indicating that they're not as confident in their business as they once were. And this could have pretty big implications into your 401k if you invested in REITs. So REITs are real estate investment trusts, and it's one of the easiest ways for you as a normal person to invest in large real estate like commercial malls or commercial warehouses or even residential properties. They're essentially just a ticker symbol on a stock exchange which you can purchase, and by owning that ticker symbol, you own part of a company which owns real estate. And individual REITs are oftentimes focused on a sector within the real estate market. So you could own a REIT which owns residential rental properties, or REITs which own warehouses, or REITs which own malls and retail stores. And if you're currently invested in any REITs which are in the hotel and hospitality space or in the retail space, you're probably not very happy right now. You're probably seeing the value of that REIT significantly decline. Now, typically, I am an advocate for investing in REITs. I see it as a great way to kind of hedge your bet and diversify your portfolio. Typically, the real estate market and the stock market are not directly correlated. So if we see the stock market crash like we did in March, you don't always see a direct correlation or direct drop in the real estate market. So there's a way to just kind of diversify your portfolio. And according to this report, commercial properties held by REITs have declined 9% year over year. Now, on the flip side of this, if last year you invested in REITs which hold residential rental properties, you're probably pretty happy right now. You're probably seeing the value of those REITs significantly increase in 2020. Now, my personal prediction is that over the next few months, we're going to continue to see home values significantly increase. So that means that it may still be a good time for you to invest in residential REITs. At the same time, though, I think we're going to continue to see a decline in the retail REITs as well as the hotel hospitality REITs over the next few months. But once we do finally get the situation under control, I'm willing to bet that the hotel hospitality REITs are going to see a pretty sharp correction. So that means that this may be a great opportunity for you to invest in the hotel hospitality space. If you own any rental properties, residential properties, it may even be a good time for you to sell those properties and take that profit and move it over into some of these commercial spaces that are really hurting right now. Now, the report also goes on to say that we've also seen a 6% increase in the number of residential land sales. And this is indicating that a lot more people are leaning towards new construction because of how competitive the real estate market is right now for residential properties. And as a real estate agent with boots on the ground within this market, that's exactly what I'm seeing as well. A lot of my clients are asking me more and more about purchasing land and then hiring a builder to build them a home, or they're looking at these new construction communities who that community itself is then buying the land. But unfortunately, it's not just that easy, and in new construction, also seeing challenges as well. According to this report, softwood lumber prices were up 81% year over year as of September. And that is exactly what I'm seeing as well. I'm having builders and contractors telling me that there is a lumber shortage right now because of this big boom and people looking at new construction. So that's actually just part of it. Another part of it is that we've had a lot of bad natural disasters in 2020, which is also consuming a lot of our wood supplies in the country. So the Gulf Coast, for example, has had a particularly bad year, and they've been hit with a record number of hurricanes this year. So a lot of that lumber is going down to the southern states to help rebuild a lot of those communities. And also on the West Coast, we had a record number of wildfires completely destroying people's entire homes. So a lot of that lumber supply is also going out there to the West Coast, once again, to completely rebuild these communities. And this is what has driven the price of lumber up by 81%, which is an astonishing number. So all of those buyers who are kind of giving up on buying a resale home and looking at new construction, well, they're now paying a premium in order to get into those new construction homes because the cost of the actual building supply has gone up so significantly. But unfortunately, it actually gets worse than that. According to this report, 39% of real estate agents surveyed in Q3 are saying that they are seeing delays in getting permits for new construction. However, this is down from 50% in Q2. So the actual process of getting the permits and getting your property inspected at every stage along the way is also getting delayed. So not only is that new construction home going to be more expensive than it was in 2019, it's also taking longer to actually get built and delivered to the client. But the number of agents reporting delays in the building process has declined from Q2 to Q3, which is a positive signal, and it indicates that the county workers have learned how to be more efficient with working from home and how to kind of curtail their whole process around this virus. So overall, I think that this report really quantifies the impact of this virus and the impact of a lot of the government regulations and shutdowns as well. We can see here that a lot of small businesses are really hurting, and that is impacting the store owners who they would rent their spaces from. So it kind of trickles down in that manner. And I really think that some of these sectors, like the retail spaces and malls, may never actually recover fully from the impact of this virus moving forward. However, some of these other sectors like the hotel and hospitality space, I think are going to recover over time, which means that these may be a great investment opportunity right now, especially if you wanted to invest in any REITs which own hotels or in the hospitality space, or would just simply benefit once travel and tourism resumes in this country. There's probably huge opportunity in those investments right now while their value has declined. If you want to learn why residential real estate has increased in value by 16% year over year, check out this video I did right here breaking down another National Association of Realtors report. Don't forget to subscribe for more real estate and financial advice. Hit that little bell icon to get notified every time I upload a new video. Thanks so much for watching, and I'll see you over in the next video.